Hello, ladies and gentlemen, and welcome back to another video. I hope you guys are having a great day. First things first, this is not financial advice, never will be financial advice. This is strictly opinion content only, and I am most certainly not a licensed financial advisor. So I wanted to do a bigger picture type video for you today, and we will get to short-term price action, sort of prediction, what I see coming or hope that's coming anyway towards the end of this video. But for now, I wanted to share with you why I am 100% invested all in GME with zero regrets and zero FOMO. Also, a bit of technical housekeeping here at the beginning of the video. Let me know if my mic volume is better. I did turn it up today. I got a few comments on previous videos saying, turn up the mic, turn up the mic. So I turned up the mic. Let me know if that did it or we need even more volume. Now, three reasons off the top of my head in particular, backed up by some data, which we'll get to, as to why I'm all in on GME. And I think that the broader thing I wanted to say is it can be especially emotionally draining and taxing to be a GameStop investor, especially when you look around at the broader market. And I will show you here, just SPY in general is at all-time highs with no signs of slowing down. And I think when you see stuff like this, you see SPY up 30, 40%. I think it's like 40 something percent off the lows, 40, close to 42% off the lows in April. I think you see people going, oh my gosh, why would I touch GameStop or Tesla? I've got a ton of drawings here, but let's see off the lows in April, 107%. And then you see GameStop and you go back and you look at the same kind of time frame in April and you kind of go, oh, it's up 12%. What? And I think a lot of people have that FOMO. So three reasons, starting with number one, why I don't experience that FOMO and really have no regrets when it comes to being all in on GameStop. The first reason is simply the fact that something is going on here. What do I mean by that? It's extremely ambiguous in general. But why does GameStop repeatedly go from relative highs down then 30% and then up another 60, 70% with no news, no reason, and nothing else? I think that's a very interesting question. And I think we have a relative confirmation bias as to why that's happening now. And a large part of this stems from the Bruno research paper. This is a university research paper titled Confirmation of T plus 35. This is all settlement related. Failures to deliver on GameStop Corp. Now, without getting into the nitty gritty, this is a very long research paper. We can look at the introduction of this paper, and essentially they're saying they're looking at the failures to deliver across various ETFs, XRT, etc. We know GMEU now is another main suspect, if you will, but they look at FTDs across ETFs, particularly to GameStop, and see why some of these, as I think better exemplified by Roaring Kitty and his sort of thumper pattern meme, why these things happen for seemingly no reason. And for GameStop's credit, I think, Ryan Cohen and management has done a really good job, if this theory is true, which I think it is, but they've done a really good job at kind of playing this the right way. And you can see with the bond offerings here in March, huge downward 30%, followed by an explosive 61% up. So they've taken this theory, and maybe they're aware of it, maybe they're not. I'm not making that accusation, but let's just pretend even that they're not. They've done a very good job at playing this volatility and coming away with cash. Now, I think the flip side of that is, oh my gosh, they're diluting, they're killing the squeeze. I'm personally not playing this for a MOAS short squeeze. Now, do I think that could happen? That's probably a separate topic for a different day. I do think that there could be very large buying at a certain period in time on this stock, but MOAS is not my personal thesis. My personal thesis is this is a major anomaly backed up by research proven data that these cycle patterns are real. And even if you don't think that they are, or if you have, your own separate theories and this, that, and the other, and you're saying that short interest is down and this, that's all fine and good. But to be 100% in on something cannot just be from the confirmation or thought logic behind T plus 35 failure to deliver cycles. You would need, I think, if you're a rational human being, more than that. So, of course, the next thing you would look at, and bringing me to my number 2 point, which would be Ryan Cohen also being really heavily invested in the company. I think it's also vitally important to say before we get too far into this video that this is not a strategy that I recommend whatsoever. It's not for the faint of heart. It's an extreme emotional roller coaster ride, and it is not at all something that I am recommending anybody else do. You would have to be partly crazy, which I probably am, to do this and stick to this strategy. Continuing on with point number 2, Ryan Cohen actually being heavily involved in GameStop. If you're unaware of Ryan Cohen's origin story with GameStop, look up why he first got interested in it. It's very fascinating. Long story short, he was a passive investor in the business. He saw some promising things along the timeline that Roaring Kitty did back in 2019 and 2020. Ryan Cohen went from passive to activist investor, meaning that he went basically all in on the company, so to speak, acquired enough shares, joined the board, and now eventually is the CEO and chairman because he put his money where his mouth is with 37 million shares and change, accounting for almost $910 million of his personal capital in the company. Now, why would that influence my investing decision? Well, because people that, going back to that whole argument about Ryan Cohen killing the short squeeze and bailing out the short hedge funds and this, that, and the other, well, it's in his best interest and his family's best interest to make GameStop a profitable business that's here for generations to come, decades, centuries, if you want to use Ryan Cohen's terms. But to actually be involved financially with $0 salary, $0, he doesn't take a dime from the company, and he has coincidentally $910 plus million invested in the stock of the company. That to me is a leader that is all in, and that's obviously theoretical, but the fact that he really is, and now he has other investments, and that's why I said that, in Wells Fargo, Apple, Alibaba, I believe as well. But to have that much money in a company that you're running certainly makes me feel a lot better than the bloated CEO salaries of people, that work at Starbucks or the other big businesses that are actually paying their CEOs north of $10 to $20 million per year minus stock compensation. So Ryan Cohen obviously is acting in the best interest of shareholders by doing some of these dilutions, even though it negatively affects his GameStop portfolio as well as it does mine and retail, whomever is invested in the company. But Ryan Cohen has proven that he can generate profits. He's a shrewd business person, the co-founder of Chewy, which is an e-commerce giant in the pet food space. Very similar shades and parallels, I would say, to GameStop, which is kind of in this transitional period between brick and mortar to online e-commerce business. But above all else, GameStop is the #1 and most recognizable brand in all of gaming. And obviously, because fundamentals are still super important, at least in the eyes of Wall Street, which is the hegemonic class that rules over the entire market, including GameStop stock, fundamentals are super important to them. And we are starting to see shades of improvement with the business. Let's look at their most recent earnings report, a 32% surprise in earnings per share. Obviously, the cash pile is helping with those matters, and a surprise $72 million revenue beat. Now, we want to see that continue quarter after quarter and not just quarters that are historically good for the company. We can see in the past they've missed revenue a little bit. The revenue is declining in general over the years, but the fact of the matter is that they're still a prominent space leader in gaming, and they're starting to become more profitable. That is the first sign of the pillar being built, of the foundation. And then you can build on top of that with the sky being the limit with power packs, more collectibles revenue, which is a growing segment and piece of the business as well for revenue. That's when you can step up and do kind of that stairway into Wall Street's good graces, which is hard to get to by being a consistent revenue generator. The third reason is because of the GameStop community itself. And what do I mean? I don't just mean because people are nice and this, that, and the other. There's actually a decent amount of bickering and arguing between community members at times. But for the ultimate sort of umbrella of people in this community, I think they're the most knowledgeable people about the stock market other than Wall Street insiders who actually pull the levers of these sort of mechanisms. And what do I mean by this? I have never learned more than I have about investing through sources like the Superstonk Old DD library, where essentially there is a ton of literature, white papers, concrete hard due diligence by members of this community that kind of pull back the curtain, so to speak, on the entire stock market, the rules that govern the stock market, the obligations that Wall Street is forced to settle by and being tied to, and the bigger picture at hand, which all relates back to why are all these bright minds so interested in GME, kind of like Roaring Kitty. And the fact that I didn't mention him as one of these points is not because he's not in GameStop anymore. We don't know. We can't say that for sure. He could still have all of his shares or more and been selling covered calls this whole time. We don't know. But he is sort of emblematic in the face of that sort of retail, super intelligent elite class that figured out some of the games Wall Street's playing with this individual equity and made a living and a fortune and a future generation of wealth for his family because of it. Apply that logic to the entire due diligence community that has really shed the light on various things like ETF creation and redemption, the failure to deliver cycles, which have been talked about, swaps, which are really under the microscope of the community now, and all of these things that are tying into the broader stock market. So there's no other community I would rather be a part of than people like that have the thought freedom, the independence from sort of the mainstream media narrative, which wants us to believe and you to believe that, oh my gosh, this is just meme driven hype where retail's bopping in $200 orders repeatedly and the stock's appreciating. That is obviously not what's going on here. And the community itself is emblematic of the fact that there are a lot of hidden mechanisms that make the stock market tick. So that was essentially the TLDR of why I am 100% comfortable with being all in on GME. Now, again, I have to reiterate, it is not something I would ever recommend. I think it's rather borderline reckless in a way, unless you have, you're kind of like me, where you might have a more intricate plan through all of this price action than just the long term. Are you selling covered calls? Are you buying cash secured puts at lower values? Are you finding a way to generate some income through all of these shenanigans? I like to call it shenanigans. So that's kind of my thinking with it. Again, it's not that I see no other value in the whole stock market. I just think this is a rather unique opportunity with something clearly going on behind the scenes that could be rather large at a certain point in time. And I am comfortable and sleep okay at night knowing that there's a lot of games and a lot of emotion going on in the meantime. Now, getting to short-term price action, I know a lot of you guys like my kind of daily updates, and I will give them to you. Let me know your thoughts in the comment below. About this kind of White House collaboration. I did a video on this that happened on Sunday night into Monday. You can see, from the lows, this got up, 10, 11%, and then immediately was shorted back down on Monday, which I find very interesting. So they settled some obligations clearly in the morning, decent volume, about 5 million shares came in, and then slowly trickled down back into kind of lower volume territory. Now we're in a little bit of just kind of flat sideways trading. Now, I'm not moving this drawing. I'm personally expecting, let me clarify, some variation of this sort of chart to play out. Maybe it'll be an extension. Maybe there was a little can kicking on Monday. Those things are extremely hard to pinpoint. What we can look at is concrete data. What also happened? Well, the lend pool borrow fee shot up over a 100% increase yesterday from 0.42% to 1.01%, and then another massive increase up to 1.44%. What does this mean? Is it just a bogus number? Well, this is the highest it's been on GameStop since the bond offer. That's a more of a bond offering type number for the borrow fee. Now, GMEU actually had its highest borrow fee yesterday on Monday, October 27th, for anyone watching this in the future, of 32%. That is astronomical. That is the highest it's ever been since the ETF was created, higher than when GameStop did its second bond offering in mid-June. So something clearly is going on. When the borrow fee goes up, that's usually the number one indicator of extreme aggressive shorting. So what's going to come out of that? Well, it's certainly a sign to me. And let's look at XRT for the kind of bow. And oh, we got a big increase today here as well. Big increase. Those are the three main sources I look at on borrow fee. Clearly, there is some shorting. I would expect there to be some sort of spring mechanism blowback off of this. But again, that's not a guarantee. This is just typically a sign and a confirmation that shares are, one, hard to borrow. The ETFs are now hard to borrow that contain GameStop. And then three, that is usually the indication that shorts are here to play, and we do not know why they would be shorting when in reality they had a really good narrative to clear some of those obligations with that sort of White House collaboration, that sort of meme drop where even Elon Musk was weighing in on the topic. So I find that very interesting. That makes me bullish short term. If I was bearish, people are probably like, "Oh, you're always bullish. You know, you're all-in shareholder." That's some of that is true, but in times where there, like Richard Newton brought a lot of light to swap season over the summer, there was nothing bullish to say for basically 3 months, essentially 3 months, from June to early September before earnings. There was nothing to say. I think we have a lot of positive catalysts now and a lot of positive things to say. So we'll see what happens short term. I'm not changing the drawing on my chart. That's kind of what I see playing out. But again, I'm not touching options on this. I'm not doing anything like that. The only options I would touch would be selling covered calls if we do get some explosive price action, and then hopefully pick up more shares if there's downside to come from that. So that's my 2 cents today. Hope you enjoyed the video. Leave a like, comment, let me know your thoughts in the section below, and I'll talk to you again real soon.